You can do everything right. The government can break the law and destroy you. My income has never been higher, and I couldn't qualify for a loan.
People that have guaranteed access to cash value, that have guaranteed access to capital, are in a very powerful position to be able to just forget about the bank. There's perhaps no unit of account more misunderstood than cash value. The net present value of future guaranteed payment simply does not register with us the way other representations of value do. If every account holder at your local bank went and tried to withdraw all of their money, the money's simply not there. It does not exist in the bank.
Whole life insurance has a guaranteed payment as long as you uphold your end of the bargain. Your end of the bargain is to pay the premium.
If we understand that there is a certain payout in the future, it has a value today based on how much time till maturity, that is cash value. That is the net present value today. The net present value is what someone might pay today for a guaranteed future payout.
Most engines get weaker over time. This engine gets stronger. Hey, good afternoon.
What's going on?
Just getting to it for the new year here. First one we're recording after the start of the new year, I think, right?
Yeah, I think so. It's January 6th today. Yeah, almost a week in, and it's going to be a good year. My wife and I were talking about this is the first year, full year out of the Navy for me. So it's kind of a nice fresh start. Last year, obviously separated halfway through, but the whole year was kind of just a weird, just pretty ridiculous, just situation with being in Virginia on that boat and all that. So it's nice to kind of have a full calendar year, and I guess the rest of my life now to look forward to without the sinking ship that's the Navy attached, even though they're still getting their hooks in. But this is the year I'm gonna get over it, put it in the past,
let it go.
And this is just gonna be a little tangent real quick because I'm still pretty frustrated by this situation. But the value of what we do here, when we talk about separating from the system, we're talking financially, but it's the same system across the board. And we've talked many times, both in our bio episodes and just philosophically, how we start coming to question things we've been previously thought were true. And the more you deal with the government, the more you deal with a federal entity, they should have no influence over your decision making, as far as like you should not be aligned with them on anything. And if you are defending something, and again, this is always going to come back to like all of the comments in our not all of them, but a lot of the comments on our YouTube videos are people that just can't believe that we would question a 401k. And it's like, it's just a tax status. That's all it is. It's just a brokerage account that qualifies for an IRS code and gives you preferential tax treatment. There are many vehicles that give you preferential tax treatment. To be so hung up on a government qualified plan when have a little bit of experience working with the government. And my most recent frustration is, when they said that I breached contract by not giving them extra time to make up for the time they cost themselves with benching me from flying. They put me in debt, collected my bonus back. When I separated, I got the Department of Defense, like finance arm, basically is like, all right, you were paying this loan that we gave you, even though we didn't, follow our procedures with that. Here's your debt notification letter. If you don't pay it, it's going to get transferred to the Treasury. And so my legal team is getting it paused, and it's going to get, canceled and everything because it's such a black and white case, right? But the amount was $43,000. January 1st, I got a letter in the mail saying that I'm now in debt to the Treasury and their collection service for $57,000. And so I'm trying to figure out where this increase came from. Long story short, I called them today, and here's what happens when they send a debt to the Treasury. They add a 30% fee of the outstanding balance, not a fixed fee, a percentage fee of the balance. Doesn't say that anywhere in any of the documents. I said, can I get an itemized list so I can actually see, and my legal team can look at, what is the breakdown here? Like, how can you tell me that I have a debt and you can't show me what it's comprised of? And she said, well, all I can do is give you proof of the debt, which is just going to be a letter that looks exactly like the one you got that just says the total amount. I'm said, well, I just don't understand, in a private contract that would never be valid, right? Just to say you have debt and not explain it, the what, the why, how it's comprised. And so I was like, well, how would anyone know about this 30% fee? It wasn't in anything I got from DFAS. She's like, well, you'd really only know if you looked up the Code of Federal Regulation, listed off this long thing. I'm like, so everyone who gets a treasury notice from, it's called cross service collections. If you get a notification from them, you're supposed to know to just look into the federal code and find out that you automatically incur a 30% fee. It's infuriating. They won't send you any documentation. They're just like, you can just pay it or not. And so I'm hoping it goes to third party collections, because a little PSA for anyone who's never dealt with third party collections. I've done it on behalf of a couple people. You don't owe them a dime. They're not a part of your contract. And so if a debt collector calls you, the only thing they can do, and it's at that point, it's already gone to your credit score, is they have no claim on any of the dollars. You are officially free of that debt. You don't owe anyone a dime. So if a debt collector ever calls you, you can have some fun. And I actually enjoy talking to them. And like I said, I've done it on behalf of a couple people. They don't owe you anything. But all that to say, apologize for the rain here. It's like every time I try to move past this situation, there's just another. It's like, okay, a 30% fee on this debt that's not even valid. Like, it's just preposterous.
It brings into question some like first principles for us too. Is like there's a presumption there that whatever this federal code is that they told you needed to look up is somehow superior to the contract law that is the basis of one of your rights as an American, and or your one of your rights from God. So if you even just look back to the Constitution, the state constitution, all these things, does that federal code that was implemented supersede any of that?
No, of course not.
Do you have the right to your property, which was the bonus that you received to uphold your end of a contract? And if that contract was broken on their end of it, it doesn't take away your right to keep the part of the contract that you benefited from that became your property. And to just claim some, it's not arbitrary, but some random code that nobody's heard of, who doesn't do this on a daily basis, and that no other American could find, supersedes those rights to that property, is asinine to begin with. So it's really about understanding the order of operations of, we always talk about order of operations. Me as a former math teacher, we talk about it financially, but even with our rights coming from God and the government being here to protect those rights, not to enforce bad law.
Yeah, and I told her, I said, I have my contract here. I don't see cross-service debt collections anywhere listed in there. Like, how do you have a claim on this? And she said, well, the contract is going to have some verbiage along the lines of, have to pay this back, and you didn't pay it back, it would be referred to the Treasury in accordance with applicable regulation. And I was like, so you can just cite applicable regulation generically and then not tell me what, like, dude, 30% increase.
30% is absolutely insane.
Yeah. And you can't just, dude, I need my sword.
It's another interesting thing about how broken this system is, because you mentioned credit score, but here's what they can do. They can trample your rights illegally. They can break your contract illegally. They can, well, first they can force a mandate illegally. If you just think about all the things that have affected you, they forced a mandate illegally, try to force it. It didn't obviously get enforced in your case, but then from that leads to breaking of their contract. That leads to applying some federal regulation that shouldn't be applied because it breaks your rights. And then that affects your credit score that was created by the same institutions that we always rail against. And it's like you mentioned on the last episode that 2024 was a great year, and you said something. You said, I made more money in 2024, or you did better financially in 2024 than you ever have. And that was even after getting kicked out of the Air Force, or I'm sorry, out of the Navy in your case, and not getting kicked out, but separating from the Navy. And so if you think about that, like, here you can be in this position where they could look at your entire debt record and see that it was paid perfectly. I'd almost be willing to bet, and we've never talked about credit because it's not a big deal to us, but I would be willing to bet that you're in the 800s. And if you're not, you're above 780 probably.
I'm pegged all the way out.
Yeah. So here you are in the 800s, considered an excellent credit risk for any creditor. And because the government applies bad law, if it goes to a third-party collection, it's going to tank your score probably into the 600s or 500s, right? Where you won't be able to get a loan in a system where they can look at your entire adult history and see that you were perfect. And they can look at your income and see that you're making more money than you've ever made, and you won't be able to get a car loan, or you won't be able to get one for a decent rate. So when we always talk about separating from the system and taking control of our finances, like, you are actually a perfect example of why that is so important to everybody. Now that you've built a pool of capital and you're continuing to build a pool of capital, you don't even have to play that game to the same level. And you can do it in a system. I always hate to bring it up, but versus Dave Ramsey, where it's like you just got to build cash and pay cash and not worry about your credit score. You're actually building it in a way that you're also building wealth and protecting your family. Like you need to write about this and how it pertains. You probably have already started writing that, but you need to write something about like everything is happening, but take it from, I think, from your rights and from the trampling of those rights to the potential destruction, especially if it happens, of credit score, to why that doesn't matter when you've broken free of the system and you control your own capital. Like it's so imperative for people to do this because like, look, you can do everything right. The government can break the law and destroy you. It should piss everybody off that listens to us.
Yeah, it should. And you should, if you're defending your government plan, like emotionally in the comment section of our YouTube, you should realize that you are literally siding with the most retarded evil entity that's ever existed. And like they don't care. There's no law here. I could tell DFAS. I did tell DFAS, hey, listen, we are challenging this legally. We have great standing to get this in precedent to get this overturned. Like the DOJ has received our notice to, all these things. Like, can you just pause this and wait till this settles out? And they're like, no, we're not going to do that. We're just going to keep adding interest, and then we're just going to transfer it to the Treasury, where now you get this 30% bump. And the cool thing is, like, all right, I'm in closing on that rental property right now, right? And I don't have I'm still in the closing process, and so my loan's not finalized for the mortgage component. I'm financing the closing costs and down payment with my IPC policy through a policy loan, and the rest I'm using a lender, right? And the cool thing is, if you are in this situation that I'm in, my credit could go to zero and I'm still going to get approved for this loan because I'm not going for conventional financing. I don't even qualify for that because I don't have 2 years of W-2 income. Now that I'm doing income on my own and it's less certain, they won't qualify me for conventional lending. And so I actually have to do what's called a debt service credit ratio, DSCR loan, where the merits of the property itself is what they're evaluating and approving it. They're saying, hey, yeah, the mortgage is $1,500 a month, but the property is already cash flowing $2,000 a month. And so based on that alone, we're going to approve the mortgage, right? So I've broken out of where I need a credit score. So for me, best case scenario is getting this thing reversed, and then I sue them for what I've already paid because I've been paying them for 2 years now on this loan, or on this quote debt. That's the best case. But second best right now, if they just send it to a third party collector, then I get the joy, the true joy that I get from talking to a debt collector. And in the past, it's been on someone else's behalf, but on my behalf, that debt collector is going to get the rage built up from sitting on a boat in Virginia away from my family for a year for no reason, while I'm watching this debt tick up as the interest accumulates. When that third party debt collector calls and doesn't realize that I know he has zero claim to a single dollar, he will never get a single penny from me. And that's not illegal because that company, those debt collectors, will buy the total debt. Like if my $57,000 fake debt, they might buy it for $10,000 from the Treasury, hoping to get 15. So they'll make an offer to me to settle, and if they can get 25 from me, then that's a huge win for them, right? Like they're buying it for pennies on the dollars, hoping to get a few more pennies on the dollar, but they don't have any claim.
They bought the debt and now it's their debt, and they'll try to use manipulation tactics to get you paid.
Yep, it's all manipulation. It's not legal. You don't owe them a dime. Never, ever, 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 ever pay a third party collector a dime, and get to the point where you don't care about your credit. Because I mean, I have an 800 whatever 20 credit score, but I'm still going to get lending for this property.
Do you think it's important to have good credit?
Yeah, I'd rather have it than not. I mean, because again, if I were getting a conventional loan, then having obviously it helps with your rate and everything. Like philosophically, no. Why I want to get to the point where I don't care about it at all. But to the degree that we still use and interact with the fiat inflationary system, I would rather have good credit, of course. Would I rather have good credit at the cost of paying this fake bogus loan, debt back to the government? No, they can stuff it. They're going to get zero from me, and then I will just let them tank my credit, and I'll manage on my own. Like, but do I want to go that route? I would rather just have my credit intact, but we don't need it because it's a financial metric that they make up and then make us think is important.
That's exactly it. You just made me start to think about that. And I had an issue when I had some transition in because I'm in the reserve. So unlike yours, where it was just straight up the same kind of pay when you were active duty, I went from what was called a federal technician at one point to an AGR to, which was like active duty within the Guard and Reserves, to a true traditional, we call it like part-time or drill status guardsman, like what they say is 1 week in a month, 2 weeks a year. So there was all these different statuses. And at some point when I had transitioned from one to another, I was overpaid. And I missed a letter saying that I owed, it wasn't even a large amount. I mean, it was, I think maybe $1,000 at most, or inside $1,000, like nothing that I wouldn't have paid had I realized it. But I think I was out of town or something and some mail stacked up. I missed a letter. So another letter came a month later, and it was that one, the date was like 14 days from when the letter was written until I received it in the mail. It was super long. I don't know what was up with the post office there. I had like a couple days to pay it. So I didn't get it done just due to whatever happened, trying to call financial services, figure out what that was going on. And then it went to collections. My credit went from around 820 to 830, dropped by like 140 points overnight. So all I was trying to do was get that reversed. So I call up the credit companies, I pay off the debt, I talk to the DFAS. They're like, once you do this, we'll send a thing saying that was all fixed and it should come off your credit. They can remove that bad report. So I paid it because I still owed it to DFAS at that point. And it was legitimate. It wasn't like yours. It was like I was overpaid in one status, and so that I shouldn't have been, due to paperwork errors on their part, of course, but I paid the price for that. Well, I said, well, how quickly will that go out? And they said, well, we will get it out within 30 to 60 days to the credit agencies. I was like, in one day of me missing this 30-day notice, basically, that my credit tanks, and it's going to take you 30 to 60 days. And then it's up to the credit companies, Experian, TransUnion, Equifax, on how long they get it taken off, and the new report runs with a new score. And they basically said, yeah, that sucks for you. So at the same exact time, since I was transitioning through those jobs, I was also working with RP Capital to buy a house. I ended up not doing it. And so I'd lost my W-2. I was on some full-time orders in the meantime. I was getting ready to go to American in a couple months with I could show them that I have employment here. Here's what my pay status is at multiple years into the contract, which for an airline pilot was pretty high. I could show them all the income I make in this business and elsewhere. I was like, my income has never been higher, and I couldn't qualify for a loan. One, because I was in this little the credit did bounce back. They're in the 800s again, but I was in this little window because of the DOD's error where my credit tanked. I didn't have W-2 income for 3 months of my life, and they wouldn't give me a conventional loan. So the system is just absolutely broken. You can get a conventional loan, but it's really challenging without enough years and they want increased income if you're not a W-2 employee. So you need to show that you're making more money each year in your 1099 income for at least 2 years going. It's absolutely crazy. And as I'm talking to the guy at the bank, and I was like, you are writing a podcast episode for me on how terrible it is to deal with banks and why everybody should be removing themselves from that system and building their own pool of capital.
And if you're in our network, our crew, Remnant Finance, like we want to build a network of lenders where we can do this ourselves among each other.
Well, just like the last episode where I was talking about buying a business, and if we're looking for an equity partner, if all of our people, we have people that are building equity, somebody's purchasing a business and wants the down payment money, you can become an equity partner, and we can do that among ourselves as we all transition and do different things in lives and build businesses, like so many ways.
And let's think about like fast forward, and we've built our capital pools up pretty substantially. We have a big network here. I mean, what if I'm in the same situation? Of course, I have my policy loan, and I can get, I can borrow that contractually guaranteed. I don't have to like worry about my credit score or anything like that. Any of these factors, because it's a guaranteed contractual right, I'm going to get that money for, say, a down payment. But if I need to mortgage the rest, and I'm in the same kind of situation where, whatever, I can't get this lending. What if I went to our network? What if I just went to you and said, hey, you have this investment group. I need $100,000 for this mortgage. Over the course of 30 years, I'd be paying, the bank would be getting 190,000 from me at whatever rate. What about let's just do a 10-year note and whatever. I mean, we could set the terms, but like people that have guaranteed access to cash value, that have guaranteed access to capital, are in a very powerful position to be able to just forget about the bank. And like the fact that I can not worry about the fact my credit score is about to tank because of this bullshit situation is empowering. And it's so comforting to see the fruits of taking these steps to separate from the system. And speaking of that, that brings us to what we actually want to talk about today. We want to do another kind of under the hoods episode here. We want to talk about what cash value is, because I just mentioned if you have a guaranteed ability to borrow against cash value. But let's break down a little bit the difference between, say, your investment group that has a capital pool that you're going to invest in different projects, and you have a bank account with X amount of money that you guys have contributed to that you're going to go put into a project. What is the difference between that capital, that asset, versus money in your bank, versus a brokerage, versus this other form of capital, which is cash value? And this is a very misunderstood unit of account. And we want to talk through what actually is cash value. I'll preface that we, on our blog, remnantfinance.com/blog, we have an article recently released called "What is Cash Value?" We want to just kind of talk through what this unit of account is, because it is not the same as what we're used to dealing with. And I think that it's a critical thing to understand what that cash value is and how we grow it, why it grows, how we use it, etc. I think it's just a very good thing to wrap your mind around as you're trying to develop your understanding and your learning here. So let's just start off very simply. What is cash value?
Well, and I think that when you wrote that blog post, and I think that your very first statement in it is important, because you hear it a lot, and it uses terms when you often hear about what cash value is from a lot of people who talk about IBC and who talk about podcasts and whole life, or in podcasts, and talk about whole life insurance. You hear this phrase that it's the net present value of a future cash flow or a future guaranteed payment, or it's always the net present value. But before you were learning infinite banking, or before you started learning about whole life and making this your expertise post Navy, had you ever really thought in terms of a net present value of a future payout? And so I think that it's almost like an intellectual phrase. And when people say that all the time, it's like you're speaking at a graduate level to people that, including myself, including you, that had a third grade level of understanding of what that could mean, a net present value of some future thing. So while it's 100% true, I don't think it speaks to the masses. And it's wild. Like the average newspaper, which nobody reads a newspaper anymore, but I remember seeing this 20 some years ago, that it was written at like a third grade level. And if you got into some publications like Wall Street Journal were a little higher, but your average city newspaper is a third grade level, because that's where people are reading and thinking. And it doesn't speak to your intelligence. It just speaks to the language that we have in everyday life. So I think, while that's true, net present value of a future guaranteed payment, breaking down what that means is important, which is what we're going to do here.
Yeah, the opening line you referenced in that article, I said there's perhaps no unit of account more misunderstood than cash value. The net present value of future guaranteed payment simply does not register with us the way other representations of value do. Yet a working knowledge of what cash value is and how we utilize it is crucial for understanding the process of IBC. That's what we want to talk through today. And we really only mostly have kind of one concept of what an account is, like what a value of money is. Like, it is a checking account, a savings account, a brokerage account. It's a balance on a screen where at some entity other than ourselves, a pool of capital is earmarked for us. Now, your bank does not have that money, right? There's the fractional reserve component of it. The idea that if every account holder at your local bank went and tried to withdraw all of their money, the money's simply not there. Like, it does not exist in the bank, right? That is the fractional reserve aspect of it, on the assumption that not everyone's coming back at once. But for comparison's sake, let's just ignore that aspect of it. And let's just say that, your $3,000 in your USAA checking account actually exists at USAA Bank. You could go, it's a little pool of money that you could go, and if you wanted to access some or all of it, it just exists and it's there. It is a hard number. It's a number on your screen, but it's an actual pool of capital that exists at the bank. Let's just strip away the fractional reserve component and distill it down to that for comparison's sake, because we all understand that whether it's money in a piggy bank, a stack of cash in your safe, or an account at the bank, that's conceptually how we view money and our account balances. But that that's not what cash value is. And we need to understand, have a working knowledge of it to best implement IBC correctly.
Yeah, and even to further contextualize the fact that that's true, if you were to go to the bank, if you have a $50,000 bank account balance and you walk into your local branch and say, I want to do a withdrawal of $50,000, you are not walking out with $50,000 that same day because it is not sitting in an account. You have to actually place an order for it, and it might take a couple days. They might be able to give you up to, say, 5,000. Every bank's a little bit different. I don't know exactly what that is, but even in the fractional reserve system, although you can log into your account and see 50,000, it's not sitting there waiting for you.
And you don't actually own it. You think you,
and you don't actually own it.
We have an assumption that you own it, but that's again, besides that, that's a little more than we're trying to cover today.
In the insurance company, it's sort of the same way. Like we look at that, we can log into our account and see that the cash value is $30,000 on this account, but that is not a separate pool of cash that is a checking or savings account that you have access to. You have access to it, but so that you can withdraw it, but it is not. It's not like this separate. It's the common thing that you hear from a lot of people out there is that like they keep your cash value when they pay the death benefit. Well, the cash value isn't a brokerage account that's sitting there gaining for you. So to start off with, I think it's important to understand that like it's not like this cash savings account in the same way that a cash savings account exists at PNC. It is displayed as one because it's an understanding of one, and it's a contractual value to that is your current value of this asset.
Yeah, and the example we make, and we've rebutted that particular claim that these greedy insurance companies keep your cash value. They give you the death benefit, but they keep the cash value. That's one of the classic, Dave Ramsey critiques of life insurance. That's such a simple and obvious misapplication of what cash value is. And the easiest analogy that we've used before, and if you look at our myths of life insurance episode, we talk about this very example, but the idea of your mortgage, your home equity versus the sale price of your house. If your house, you knew for sure you were going to sell it at the 30-year mark, guaranteed you're going to sell it, and you know the price right now, let's say it's $1 million house, that is the future price, but your current claim in that right now is the home equity, right? So you start paying your mortgage, you don't have much home equity, maybe you're 10 years into paying it, maybe you have $150,000 of home equity because you've been paying into this mortgage, most of it's gone to interest. Over time, more of it goes to principal, and you're going to sell it for $1 million, but we're still 20 years away from that point, right? If you sell it today and you have an outstanding mortgage of $850,000, we just bring that future event into the present, and you were to sell the house for $1 million today, say, hey, we're actually going to move, rather than waiting till our future selling point, we're going to sell now. We sell it for $1 million today. We have an $850,000 outstanding mortgage on it. We've gotten 150, the remainder is equity now for us. When you get that kind of simplifying the actual mortgage process, you don't actually get the whole $1 million because the lender gets paid off first. He's the first claimant. The lender is the first claimant on the proceeds, and you get the rest. So you're not actually going to get that $1 million transferred to you. But let's just say I sell my house to you. You pay me the $1 million, and then I have this mortgage for $850,000 left, right? In this instance, I would pay the mortgage off for $850,000 and I would keep $150,000. That's my equity. But the application here and where that statement about the cash value falls apart would be like if I sell my home to you for $1 million and you write me $1 million check. If I were to then say, hey, yeah, the sale price was $1 million, but I had $150,000 of equity. What about that? You would say, well, that was just a representation of your current ownership of the $1 million sale price. You don't get the $1 million home price plus the equity that you had. The equity that you had was a component of that total sale price, right? That we can all understand why that's the case. And now we just switch it out where the sale price is when you die, that death benefit. We are planning to live a long life. I have $1 million policy and I have $150,000 of cash value. I'm planning to live a long life and eventually that cash value equal my $1 million. But if I die tomorrow and now we've moved that home sale price or we've moved that death benefit payout to immediate to the present, my wife wouldn't be able to say to the insurance company, hey, thanks for the $1 million, but Hans also had $150,000 of cash value. Where's that? That cash value is just a component of the $1 million.
Yeah, and I want to back up a little bit because I think there's an important thing that's being missed and not being missed, but I think there's an important part of this discussion is is why whole life insurance gains a cash value and why it's an actual asset versus a term policy that doesn't build cash value, which is what most people understand whenever they have life insurance or they have group life insurance or something. And it's just that it's almost like what you're saying. It's the renting, to make the same comparison. It's the renting versus the owning idea. Whole life insurance has a guaranteed payment as long as you uphold your end of the bargain. Your end of the bargain is to pay the premium, to pay the minimum premium. When we structure these, as we've talked about in other things, we add a whole bunch of things. We might add term, we might add disability waiver premium. So if you ever get hurt or sick, it continues to the life insurance company will then pay the premium. But you can boil these all the way down, and you have the option to do this all the way down to just the basic premium for the whole life insurance. And that is your only obligation. So it's known as a unilateral contract. When you pay that, if you uphold your end in some capacity, you don't even necessarily have to pay it out as cash. You can pay for it with the dividends. You can pay for it with the cash value over time. You can pay it with a policy loan. But as long as it gets paid, the company's guarantee is that they're going to pay a death benefit. So all the way back to the first thing we said, that there's this net present value of a future payment. That's the death benefit. So that is a cash flow that's going to happen someday, 100% guaranteed. It's contractual. Whether that cash flow happens this year and you die young, or if that happens when you're 95, it's going to happen. The value of that's probably going to change. So the reason it's building cash value is because it's a guaranteed asset. So another place that this varies a little bit from what you were talking about the mortgage is the mortgage example works because everybody understands it and it's a great analogy. The place it doesn't work is things can change. Nothing's guaranteed in your mortgage. Nothing's guaranteed in the price of your house. We saw that in 2008. People that had $1 million homes suddenly had $400,000 homes in certain markets, places like Las Vegas, for example, where it just absolutely tanked.
You're describing a universal life policy, basically.
I am describing universal life policy as well, but
in this analogy,
which is why we would never do it. But even with the home, you don't know that your equity is even real. It's equity based on the present value. It's not based on a guaranteed value. It's based on today's projection of what you could sell it for. And if that changes, which it can with the market, because it's just statement wealth, which means the statement of your, if you get on Zillow, I'm just going to use it and say, what's my house worth today? Mine fluctuates every month if I look at that. Sometimes it goes down $4,000, sometimes it goes up 10. I don't know what the real price is because I'm not pricing it to sell, but it's my equity moves with that. It goes up and down with that. And so it's not a perfect example. Whereas with guaranteed whole life insurance, especially with dividend paying, your death benefit won't go down. So over time, that equity that you're building in the as cash value, that part of the contract that you have ownership stake in, if you will, that you've paid for, continues to grow no matter what, and it will only ever expand. The market can't change it.
The last recording, we talked about switching from the idea of buy term and invest the difference, which is horrible advice for everybody, to create an estate and invest the difference. And one of the claims I made was that by the time you finish this episode, you'll understand why making that claim of, why didn't I get the cash value and the death benefit is a nonsense statement. It's not a hard statement to understand for those who are listening, but not like who get lost on the insurance talk. Let's just strip away some of the insurance aspects of it. And let's just give like a very simple example here. So I'm going to say this little notepad here is this investment that I made, and it's payable in 1 year. Whoever's holding this will be paid $10,000 in 1 year, right? However I came across this little notepad, the holder will get a check for $10,000 in 1 year. Think of it like a bond, right? I mean, like a CD, a 1 year CD, right? You pay a certain amount for it. And in the future, in this case, in 1 year, you get more. So whatever I paid for it, who knows? But right now I have this notepad, and the holder of this will get $10,000 1 year from today. Now, would you buy this from me for $10,000 today?
No.
Why not?
Because I would be paying the exact same amount that it's guaranteed to pay out 1 year from now. So I would be technically losing money on the time value of my money.
Right. You would be deprived of your 10,000. You'd have to wait a year to get nothing back. You wouldn't make $1 on that. Yeah, it wouldn't make sense. But what would you pay for it? Maybe. And this is subjective, but let's just put some numbers on this.
I might pay $900 because I know that I'm getting about an 11% increase guaranteed. So let's say I would pay $900 for that.
9,000.
9,000. Yeah, I'm sorry.
9,000. Yeah. So this is $10,000 return. You might pay 9,000.
I might, yeah, I probably would, knowing I'm getting an 11% guaranteed return in 1 year.
Just with that alone right here, what we're saying is this is a guaranteed payout in the future of $10,000, and it has a net present value to worth today 9,000, right? So you would pay $9,000 for this today for 10,000 in 1 year. Let's say today's January 6th. Let's say fast forward 6 months. You didn't buy this from me today, but in 6 months, we're recording the podcast on June 6th. And I say, hey, remember this thing? This is going to pay out on January 6th, 2026 for $10,000. If today on January 6th, you were willing to pay me 9,000 for it, and I say, hey, remember you offered me 9,000 for this back 6 months ago? Well, 6 months later, this pays out in 6 months, in January 2026. Yeah, you still want to pay that 9,000?
Yeah.
You would. That's a good deal for you, right? If I would take 9,000 today, would I take 9,000 in the future?
No.
No, right? So somewhere in between 9 and 10,000, like if I would take 9,000 today, I would require more because the wait time is less. So you would love to pay this. You would pay 9,000 today. You would love to pay 9,000 in 6 months, but I wouldn't. If it was worth 9 today, it can't be worth the same to me 6 months from now because I'm halfway there. Like I've done 6 months of the quote work, so I would require more payment. So maybe I would say, hey, had you gotten it a year ago or 6 months ago, and I had time to grow that money on my own, then I would have taken 9,000. But if you want it today, it's going to cost you 9,500. Would that be worth it? Maybe.
Probably. But yeah, and conversely, from the holder of the note, if I had bought that and I come to you 8 months later and say, "Hey, I have this thing for 10,000. Would you sell it to me? Would you close it out for 10,000
If I have 4 months until it pays out,
until it's supposed to pay out?"
I wouldn't pay 10,000 for it because then I would still lose money.
You'd say, "No, well, I didn't get the full term that I was planning for to grow the money above 10." Because obviously, if you're holding that, you're planning on that money being worth more than 10, so you make some money because we're all capitalists and everybody's going to make some money. So you, as the issuer of that note, was planning on saying profiting to 11,000, and you're going to pay me 10 because I put my money into it. But you didn't have the time to profit 11,000, so you're not going to give me 10 for it early, which is the from the other, you were speaking as the person who issued the note. And let's, like, to draw it back to whole life insurance, you're playing the role of the insurance company. Me as the consumer who bought the note, who bought the contract and is paying the premium, if I want to close it early, I don't get that max value. I don't get what the death benefit should have been, even if I'm 80, because they planned it to 121 years old, even though nobody's lived that long yet in America that I'm aware of. So if I close it early, that's why you now get this certain cash value. What it actually is a cash surrender value. So this is the amount of money we'll give you if you surrender your policy early. So if you gave me 1 year to close your example note, same thing on the whole life. If I want to close the policy early, they say, well, based on the money you've paid in, for the amount of time you've paid it, for the length of the contract, now we're at this point somewhere inside that time frame. This is how much we will let you surrender the policy for. This is what your current value is, because you didn't see the whole timeline. You didn't pay the premiums as long as you were supposed to pay. So we can only give you a portion of what this thing was worth. Now, the death benefit side of it is the insurance side, so we don't need to speak to that. That's going to pay no matter what, the full amount. That's the risk on the insurance company side that's pooled. But so yeah, I can't sell that note early for what the value is, just like a savings bond, an EE savings bond. It's a similar idea, the old fashioned one that grandmas used to give you.
To take it to an extreme with this, just to finish up with this analogy here for the non-insurance minded people, like let's say this pays out at the end of the month now. I only have 30 days to wait to capture my 10K. At that point, you're pretty much going to have to pay me almost the entire 10K. Like I'm not going to take much of a haircut on this thing. I would have taken $1,000 haircut a year ago, knowing that I could do something with that money. But like, I would rather just wait the 30 days to get my full 10K. So you might get a little bit of a discount, but you're not going to get that same price. And conversely, if this pays in 2030, so you have 5 years, and in 5 years, you're going to get 10,000. What would you pay for it today? Would you pay 9 for it today? If you have to now wait 5 years to get it? No, you're gonna pay less than that. It might be worth 1,000 to you, maybe.
Maybe 3. Yeah, I don't know. I'd have to run the numbers, but a lot less.
Yeah, if we understand that there is a certain payout in the future, it has a value today based on how much time till maturity, that is kind of in a nutshell, like that is cash value. Like that is the net present value today. And if we add one more wrinkle, let's go back to our initial situation where you were willing to pay me 9,000 to be paid 10,000 in a year, right? But if I add another wrinkle on here that says, okay, yes, you get that, but at the same time, you also have to pay the fee associated with this. So in order, whoever holds this note has to pay $50 a month to keep it in force. So would you still pay 9,000 for it? No, the value of that would have gone down because by taking this and holding it for a year at $50 a month, you're assuming a $600 charge. Right now, as the holder of it, I'm going to pay the $50 a month for the next year. So the $600. So now maybe it's only worth 8,400 to you because that's what it was worth plus the 600 you're going to have to pay over time. It might be worth 8,000 to you, whatever it is. But when we add on the fact that you have to pay something in order to keep the rights to claim this in a year, it's going to be less than it would be if you didn't. So that kind of speaks to like a paid up insurance. There's no more additional payments needed to keep it. So it has a higher net present value now than it would if it required more premium payments, i.e. your base premium takes a while because there's a lot of future payments assumed with it. And so if you just can kind of like wrap your mind around that without the insurance terms, the net present value is what someone might pay today for a guaranteed future payout, but there are factors in there that will change whether that goes up or down. And so again, yeah, this is the death benefit, and it has the premiums, which is the amount you have to pay to keep that death benefit paying out in the future. Well, that affects the cash value, and how many years until payout, that also affects the cash value. That kind of example sort of helps you contextualize.
Yeah. So in terms of life insurance, a lot of things happen. Like, is how much are you paying and your monthly or your annual premium? How old are you when you start the contract? What is the terms of the contract? When do the payments stop? Because we can write these to be 1 year, 10 years, 20 years to a certain age, all the way to age 121 if you live that long. That's all factored into how fast the cash value grows because of how long and how much money the company is going to receive in relation to the payout, the death benefit.
And you mentioned 121 earlier. Can you elaborate on that a little bit more and how that would, like, what that means in the context of our example here?
Well, the company on an actuarial basis, they write these all to what's called endow, which means it's going to reach its full value at age 121. So no matter what age you start, I'm 43 right now. If I were to start this, that means it has what about just under 80, 78 years for that thing to accumulate and reach its full value. So I'm going to pay premiums to a certain point, and that could cut off, like we were saying, at 65, 75, 95, or I could plan to pay all the way to 121. So they're factoring those payments, and they're saying no matter what, the length of time when this thing reaches full maturity and endows is when you reach age 121. So it's all calculated based on that. Here's the money you've put in, and here's where it's going to reach its maximum value at this point. And at that point, you've reached time zero or 100% of the contract, and they would just pay it out because now there is no more net present value to catch up to that. There is no more maturity. It's a fully matured bond, if you want to think of it that way, a fully matured contract.
And that's why if you look at an illustration, it goes all the way out to age 121, and your cash value at age 121 equals your death benefit, right? Because for the same reason I said, if this pays in 30 days, I'm not taking much of a discount. You're going to have to give me pretty much the full 10K to make it worth it for me to take that haircut.
And if you look at one of these contracts and you look at an illustration and go to age 121, and let's just simple numbers say it's $1 million death benefit. If you go to age 120, your cash value is probably going to be about $990,000. I don't know exactly what it's going to be, but it's going to be so close to $1 million. It's almost fully matured. So you couldn't buy it, and you really wouldn't even want to sell it.
Yeah, and you can kind of think, you always hear like cash surrender terms, because again, most people's understanding of life insurance, of whole life, is base only. Most people that have it, a lot of people just cancel it because they don't understand it. And so people are familiar with cash surrender value or surrender value. Well, it's the same kind of thing. You're basically saying, hey, saying to the company, hey, you owe my wife $1 million. At some point, you are going to pay my wife $1 million, right? Whether that's tomorrow if I die, or if I die in 30 years, or if I live to 121, you're just going to pay me the $1 million. But you are on the hook for $1 million. I'll let you off the hook for X amount now. You remove that obligation from you is worth something today. What is that $1 million worth? Well, again, all of these factors play in to get us an actual current net present value of what that's worth today. And so, like you said, the closer you get to that point in time of age 121, the guaranteed payout, the more the cash value is going to match that death benefit.
And one of the reasons that that cash value grows and you can surrender at a certain point at a certain value is you've given the company enough time to take your premiums and do something with it for the company to be profitable. And if you look at a standard based contract in year one, your cash value is likely zero on just a standard vanilla whole life insurance contract because they've collected your first premium and they've done all of the expenses are on the side of the insurance company. So there is no current net present value because they haven't had the time to let your premiums do work for the good of the company, to pay for the expenses of the company, to pay for the profit, or to pay for the investments, to pay for the underwriting and the commission and the administration of the policy and the issue of the policy. And then in year two, you get a little bit of cash value because now they've had two premiums. They've started to put that to work. Major expenses have been paid to put it in force on their end. Their money's starting to go to work. They say, okay, so we've collected this X amount of premium from you and we've been able to grow it to Y, but it still hasn't grown enough for us to pay out the equal premium or, an equal amount in surrender. So each year you give them another payment or monthly or however long that is each year, more of those premium dollars have gone to work on the behalf of the company. And at a certain point, let's say in 20 years, well, they've taken all your premiums. They've actually made pretty nice profit on their end with those premiums. They put that money to work on your behalf as a part owner of the company. And if you surrender it, you can surrender it for more than you've paid in because it has a higher value, but less than the death benefit. So it all comes down to, again, that time value of how much premium you paid on your end and what they're willing to surrender it for. And that's why it's really low in the beginning. And it's one of the false reasons that everybody says, like, it takes forever to even be equal in cash. Well, you're not just putting it into a brokerage account gaining interest. You're putting it into a machine that does something with it.
That is going to return more eventually to your family. And that's the thing. You could make one premium payment and die the next day. They're going to pay out the whole amount. And the principle of insurance is that they're pooling people my age. So when I got my policy, like 33-year-old males of preferred health rating are all pooled into a category. And for every 100 of us, they expect that in the next year, like maybe one of us is going to die. Right. And so that one person that dies is going to have made one premium payment, but get the full death benefit paid out. And so that is the cost of insurance, is the fact that early on there is an outsized exposure to them. And again, as you pay down over time, and this idea of the fact that over time your cash value will grow to your death benefit guaranteed, it's like, that's how we can separate. That's how we can make our first separation away from our typical mindset around saving, investing, growing money. It's not that our cash value is an account at the company that they're applying interest to based on the market, et cetera. It's literally the passage of time. As time passes and as premiums are paid, both of those factors contribute to cash value. But literally, the passage of time is the most powerful engine in cash value growth because it has to catch up to the death benefit one day.
I want to grab that real quick before the thoughts change. One thing that we've really, really latched onto and talk a lot about is the generational aspect. And Nelson taught we should be thinking 70 years into the future. So me at 43, my dad died at 64, my uncle 69, my grandfather 64. I really hope I live at least into my 80s, but it's very unlikely I have 70 years in front of me. But that passage of time is the one thing that's going to happen anyway. So when we start thinking generationally into this, there's nothing that can do more than the passage of time for our future generations to really build an extremely powerful engine that's just going to keep on getting stronger as time goes on. And that's the amazing thing about this. Most engines get weaker over time. This engine gets stronger.
And we hear quite often, people get really excited about doing IBC. They understand, I want to do policy loans to buy rental properties, whatever, all the stuff we talk about, get excited about the living benefits. And they say, well, I want the cash value. I'm not really worried about the death benefit. Well, if we're telling you right now that guaranteed one day the cash value will equal the death benefit, whether you make it to 121 or you die early and it just jumps up to that death benefit amount and goes to your beneficiary, the larger, like, there is no cash value without death benefit, right? And one day your cash value will exactly equal your death benefit. So how big do you want that death benefit to be if that entire death benefit will one day pay out and the cash value will grow with the passage of time to equal that? You know, the phrase, I think it's Jason Lowe and Richard Canfield of the Wealth Without Bay Street podcast. I think they've changed it recently, but I think they have a book called Cash Follows the Leader. It's basically the idea of like, if you have two participants in the race, your death benefit and your cash value, and you know that cash value will one day catch up and equal death benefit, how far of a head start do you want to give the death benefit if they're just going to, if it's going to have to plow ahead by the passage of time?
So when you think about that as an estate value, it's like your other places that you put cash, you hope will grow to a certain place. This asset that you put in force is guaranteed to be at that certain place for an estate value. And it's a lot different than thinking about just an accumulation for a retirement number.
And this, you know, of course, we touched on the self-completing part too. You know, maybe I am getting great returns in the market, and I have projections that are going to show that if the market does X% a year, then by the time I'm 65, it's going to be a $3 million nest egg. Right? That's all well and good. You know, not even here to talk about the taxes, the fees, et cetera, all that stuff on it, like all the eroding factors, but just the fact that if I'm 30, so I'm 36 today, and I have these projections to have a $3 million nest egg at 65, if I die tomorrow, that is truncated to where I'm at today. It's not self-completing. And when we talk about the cash value will equal the death benefit, it's because the cash value is the death benefit. It's just, what is it worth today before it inevitably pays out in full one day? And so how do we actually use this now? How does this allow for policy loans? Why do policy loans have such favorable terms? Why are they unstructured? Why is there no repayment schedule? Why is it the most efficient lending? Like, from the company's point of view, they know they're paying this out, and so they will make themselves whole off of that. But how do we actually use this idea, this understanding of cash value now? Having certainty of a future payment in the future allows you to make different decisions now. And the example of, we need to renovate our home for $50,000. That price tag is scary. But if then you add the wrinkle that, you know, in 1 year your uncle is going to die and leave you $500,000, does it change your decision? Like, the fact, like, future payouts can change your decision. We're not talking about a bank account at the company. We're just talking about your current slice, your current net present value of this future payment. But how does that change your behavior today? Like, what can you do with that actually gives you some economic leverage and some power here? How do we think differently in this, knowing this?
Like you said, as we've all talked about for so much here, it's the net present value of this future payout. That future payout, anytime prior to age 121, is always larger than what the net present value is going to be, because we haven't had the full time horizon. So the company, as you kind of alluded to, they're completely made whole no matter what. Like, you're leveraging against that cash value. If you decide to close the account, you have a lower net surrender value. So that's why the company loves these, and that's why, like you said, they make it profitable. On the death benefit side, they simply reduce the amount of the death benefit by the policy loan. So here I can make decisions with that policy loan, such as if I want to purchase something big, if I want to go into an investment, I don't have to think about, I'm draining capital from the same pool of capital that I've accumulated that needs to do all the jobs of my life in order to take this risk, or in order to purchase this thing, or maybe it's even a vacation home that I just want to build family memories with. And I might think like, man, do I want to take on all this debt? How's my wife going to pay this if something happens to me? I know whenever I take this cash value loan, this policy loan against my cash value, that if all goes wrong, I own that asset, or I own that portion of the asset, or I own that thing that I've taken the policy loan for. And should something happen that upsets my financial life, the future payout will cover that, guaranteed. It will cover all the decisions I make utilizing a policy loan, because it's going to be more than what I had access to. It's going to be more than what I took the loan for. So if I buy a rental property for $100,000 with my cash value, and let's just say I purchase it outright, I don't have to, or even if I take a mortgage against it, that policy loan is completely covered by the future payout that's going to be greater than the policy loan itself. So my wife is made whole in any way that I have incurred some sort of debt, I'm going to call it, even though it's not a true debt. It's always made whole. It's always covered. The principle of what I've done has been protected based on that future cash flow, as long as I keep up the obligation of paying my premium.
Yeah, and that brings in a component of, like, the collateralization of future value is a very real asset. It's just not one we think about often. So the example that you tell people, that I think is applicable here is how can that fact that there is this future payout alter our decisions today? And so the example that you give sometimes is, let's say you have a home repair, you want to remodel your kitchen, and the price tag, and I come to the contractor and I'm say it's 50 grand if you want to do this. We might be a little hesitant about that because that's a big price tag. Do you want to sink this capital in there? But how could the certainty of future payment influence your decision today, even before that payment's realized?
You lost me on that part. Even though it's my example, apparently, I think I'm misunderstanding your question.
Would you feel comfortable spending 50 grand today if you know you're going to get an inheritance of 500,000 from an uncle?
Yeah,
Right?
100%. Yeah.
That's what I was trying to get you to. With the idea like behavior, but you can modify your behavior today and feel comfortable in decisions, even though you don't have this money yet. Like the value of certainty and the value of future payment can still factor in today. That's what I was trying to get to.
Yeah, of course. And I think an easier one to think about personally is even is just looking at the accumulation model with whole life insurance or with this death benefit that's future going to pay out. That I often ask people is like, if you've saved $1 million, let's say you do have a 401k, and you've saved $1 million, are you afraid to make decisions on spending that money? And the average person, I just heard this, and I don't have any real data to back it up, is like, in 7 years, their financial plan is falling apart after retirement. And that's a lot of times because of how that money is applied and what they have the safety to do and the time that they have in front of them based on the amount of money they have. Like, are you afraid to spend that $1 million or spend a lot more of it if you know you have this guaranteed payout later to take care of your family? I think that's an easier way to wrap your mind around the question that you were asking. I get what you're asking, but I want to change it and say, like, are you afraid to make decisions with this money when you know you have this future cash flow, even if it's not via policy loan later? It creates a level of certainty and security that nothing else will, because you have a guaranteed cash flow for your family. So spending that money for the house repair, spending that money, for yourself or for vacations or for lifestyle or buying a home becomes a lot easier when you know it's all covered someday. Every single penny of it. I don't even necessarily want to say take more risk, but you can enjoy your money to a greater degree now, knowing that it's all going to be recouped, even if you hadn't recouped it in your own lifetime.
Yeah, exactly. It's just powerful to understand how future certainty can impact decisions today and make them less risky, more palatable. It can take pressure off having certainty in place, and the economic value of certainty can't be overstated, but it also can't be put on a spreadsheet and compared, rate of return, A versus B, A is bigger, so A is better.
An actual perfect example, if I can give like a real life one, is in my investor group. There was talk like, if this deal is good, would everybody be comfortable dropping in another $50,000? And do you know the 3 people who didn't hesitate? Me and 2 of my clients. It didn't even hesitate to say, yeah, we'll do it. We'll put another $50,000 into the pool of capital to do this bigger deal. But the people who are taking money from an outside source from their savings, it's a little bit of a like, we really got to analyze it and make sure, and and really, like, they're unwilling to take the quote risk in the potential deal because there's no wall of protection around that capital. And that's really the bottom line, is I'm willing to take that policy loan, stuff it into this other thing, this other group, and make bigger moves with it because I have a wall of protection around that capital, and that wall of protection is the future cash flow.
Yeah.
And the fact that net present value continues to grow. That's the part that we always talk about, that's commonly talked about with the cash value, as if it's an interest and dividends that grow on it. It does. That's continuing to grow anyway. So it's self-repairing, if you want to think of it that way, on its own with the passage of time, even before I start paying it back.
Hopefully we tied in enough points together that you can kind of wrap your mind better around what cash value is and what it isn't, how we use that to our advantage, and why we talk about and emphasize the death benefit as much as we do. Because of course the protection factor is the first thing that we need to address. It's no good having a big pile of money if it's exposed to a lawsuit, to disability, or to death, right? Is it going to pass through probate intact and go on to your heirs as you desire? Is it going to be taxed? Is it going to be gone? Probate lawyers, whatever. Like, the protection component is key, especially if you're young. If you can't get to that 65 retirement age where your portfolio has been building under the CFP model and you see these beautiful numbers, if you don't make it there, none of that mattered, right? And so the protection component is key for your beneficiaries. But not only that, building a large pool of future guaranteed payout via the death benefit simply means that you're going to make the passage of time more efficient for you, because again, that cash value has to catch up to the death benefit. That's why we harp on it so much. It is the protection component and it is the cash value component. Ironically, when people get so focused on cash value and seeing this as just a way that I'm going to be a little more efficient with my investing activity by policy loans, like I just want the policy loan aspect of it. Well, if you're dialing down the cash or the death benefit as low as possible, you're robbing future passage of time from its efficiency.
Yep. You're inhibiting that growth. Yeah.
It's just going to meet a lower number one day down the road. So yes, we want to be able to pay as much PUA as we can. We want our cash value, all other things equal. We want our cash value to be, dollar in, dollar out, all these things that people initially focus on. We do want those things, but at what cost? And we do not want to sacrifice the future, one, the protection, and two, the guaranteed growth that is inherent with the passage of time in a contract.
And I'll say on a personal side of this, like I'm extremely satisfied and secure and glad that, I mean, I pay very large premium in respect to my income, probably larger than outside of people who've really been in this and understand it for a long time. In comparison and ratio of my income, I pay high. So currently, my net present cash value is the largest asset I have in my life. It's more than the equity in my home. It's more than the balances I have in other, insecurities, such as a 401k and TSP and all those other things that I have. It is the largest asset that I own right now, and that's awesome because it lets me make moves with certainty and moves with guarantee in my financial life that is growing my wealth more quickly than it's ever grown.
It's really powerful. I would recommend, if you want to dive into this more, check out the link and read the article mentioned there. And then we've also got quite a few other articles on the blog as well that walk through some of these components, these under the hood kind of components we talk about. But just schedule a call if you want to just chat through this stuff. But it's vital to understand conceptually what this is, just because it is different and it's the most misunderstood unit of account. You got anything else on cash value?
No, but I did have something else that I wanted to read real quick right before you pivoted into the actual discussion. This when we were talking about inefficiencies and all the BS of the government. And then let's just end it here just so we can giggle about it and then just laugh. This is a PhD classmate, college professor of mine on Facebook commenting on things. And I just want to tell you how broken the system is and what people believe out there and why we should separate it. He said in a comment to a discussion, "I'm not sure how you expected the country to recover economically without spending money to shore up the US economy, which is the envy of the world under the Biden presidency. You're also making the assumption that Biden caused the inflation, which is inaccurate." Let's just end there, just so you can have a giggle on what the conventional, I shouldn't even call it conventional, the typical modern day wisdom around government and economics is. And you should leave that. You should separate yourself from that. This is a person that is teaching at a college level.
I've asked Janet Yellen these questions. I mean, not these questions, but my foray into macroeconomics was asking Janet Yellen and Jason Furman and Larry Summers questions about that, just did things that didn't make sense to me before I even understood any of this. Like the adults are not in control of the car here when it comes to economics. And so you need to take control. You need to stop being a passenger
And take control of your capital.
Yep. All right. We'll see you next time.
Yep. See you.